All right, good morning, everyone, and welcome to our PAISBOA Wednesday webinar for March 27th, 2019. My name is Ron Hill, and I'm pleased to introduce Dan Froehlich and Joe Bosch of D.A. Davidson Company, who will present debt financing for independent schools. A little bit about our presenters. Joe Bosch and Dan Froehlich are both Senior Vice Presidents of D.A. Davidson in the Public Finance Division of Investment Banking. Joe has focused his most recent investment banking efforts on the financing needs of higher education, independent schools, and not-for-profit organizations. He has served within the public finance departments of Janney Montgomery Scott, George K. Baum and Company, Fleet Securities, and Drexel Burnham Lambert. Dan is involved in the execution, development, and structuring of both tax-exempt and taxable debt financings for college and universities, independent schools, and other nonprofit organizations. Dan holds an MBA from New York University and a bachelor's degree from the University of Pennsylvania, and his PAISBOA connection is that he's a graduate of Germantown Academy, one of our member schools. So welcome, gentlemen, and I'm going to turn it over to Dan and Joe. So enjoy the webinar. Thank you, folks.
Good morning. Thank you, Ron. It's a pleasure to have the opportunity to speak to you as a group again. We did have that opportunity about a year ago in person at a gathering. And just a word, one further word, I guess, about Dan and I. We have worked as a team since 2005. And during that period, our concentration has been exclusive on not-for-profit corporations. And they include, very importantly, independent schools, higher education corporations, standalone student housing project financings, cultural organizations, human service providers, and other not-for-profits of all shapes and sizes. Since 2005, again, as a team, we've sole managed 92 financings for not-for-profit corporations, totaling more than $2.13 billion in aggregate amount. We will explain both the process of tax-exempt financing during this presentation and explain a variation of the service that Dan and I provide to our clients, which is referred to as the dual track financing process. That process enables a entity that is approaching this scary proposition of the tax-exempt marketplace by having a third party explore thoroughly both the public bond sale and the private bond placement options on their behalves. We will return to that topic of the dual track financing process a little later in our presentation, and would like to just leave this introduction with the notion that D.A. Davidson has served independent schools as a placement agent. We've also acted as an underwriter of publicly sold securities, and on several occasions we have served independent schools as their financial advisor.
Okay, before we get move any further, I just want to remind our listeners, if you have a question, you'd like to raise a point, feel free to use the chat function. Just click on the chat and then we'll interject your question when it's an appropriate time. So gentlemen, continue on. Thank you.
Thanks, Ron.
Thank you, Ron. Just a quick word about D.A. Davidson before we get to our main topic. The company was founded in 1935, and somewhat uniquely, it's employee-owned, which is rare for investment banking firms and financial services firms. We think that that's a nice distinction. There are more than 1,300 employees nationwide, and in 2018, Davidson is ranked 6th in the nation for the number of tax-exempt bond issues underwritten. We were 5th in 2017. And the last point about the company is that the company is very well capitalized. So with 154 million of net capital. So if there are bond issues that our clients want to undertake, we have the resources to do that.
I'd like to spend just a couple moments to go into more detail about the potential roles of an investment banker as that actor assists you if you are going through the process of borrowing a significant amount of money for capital facility improvements. Conventionally, historically, tax-exempt bonds, which are bonds issued on behalf of not-for-profit corporations, have been sold to the general public. And in that process, the investment banker works with independent schools, in this case, or an independent school, to formulate a borrowing process, assist the borrower in walking through the public issuance process and all the legal documentation associated therewith, and ultimately shows up at closing with a check. That's very dramatic. That doesn't happen anymore. It's really a wire transfer. But the underwriter purchases the bonds from the issuer. And then it is the underwriter's responsibility to distribute those bonds to the general public at prices which are tightly regulated by our regulatory agents. When an investment bank serves in that capacity, as for example we have done historically for the Hill School, the service is we are called an underwriter, and we are regulated therefore. A new version of the marketing of tax-exempt obligations emerged approximately a decade plus ago, primarily in response to the freezing of the financial system that we all lived through and know well. Part of the reaction there too was to have commercial banks step forward and realize that they could purchase tax-exempt bonds into portfolio, and that would be economically compelling for them to do that. That led to the following decade plus of activity in the tax-exempt bond arena, where I dare say that probably 3 out of every 4 new bond issues or more issued on behalf of not-for-profit corporations are structured as private placements to commercial banks. In that process, were you to work with an investment banker, that investment banker could serve as your placement agent. And if that banker is functioning as a placement agent, they structure and arrange private debt transactions with the banks. They do that by soliciting interest from the banks in the form of the distribution of a comprehensive credit package. That package should be a joint product between you and the placement agent, and it should be fully approved by you and vetted before it is released to the banking public. Dan and I routinely distribute such packages to over 35 financial institutions. We then ask those financial institutions to make proposals back in the form of written term sheets, which will provide options for our clients to consider the placement of tax-exempt bonds, either on a fixed rate or a variable rate basis. And also, we always ask those financial institutions to give us a proposal for what a non-tax-exempt or conventional financing might look like as well. We then work with our clients to quantify those term sheets, and it's probably never the case that we're going to get 35 or 36 responses, but in many, many cases, we do get double-digit responses on behalf of independent schools. What we find is that it's probably pretty easy to shake out the top 1 to 5 proposals and to push the others to the back burner, and then to work with our clients to probe in depth the different elements of the most attractive proposals. We then usually re-enter the marketplace to renegotiate terms and conditions with those entities that have been most aggressive and most attractive to our clients. And ultimately, our client decides which proposal they believe is most appealing to them. The other thing, to confuse you a little bit, but the other thing that Dan and I do during this process, if it is attractive to our clients, is we fully explore the other option, the underwriting option, to show what the cost, terms, and conditions would be like were the borrower to select to sell bonds to the public. And again, as we go through our presentation, we'll go into much more detail about the differences between the two. Finally, you may choose to use an investment banker in a different capacity, and that is a capacity generally known as a financial advisor. Financial advisor, the role of a financial advisor is similar in many, many respects to those of a placement agent. However, a financial advisor is not necessarily engaged in relationship to a specific transaction or a specific financing, but may be engaged to assist a client in preparation for various other activities that precede or come after the issuance of tax-exempt bonds or the procurement of a conventional loan to facilitate capital facilities financing. When we negotiate with our clients, when we're engaged by them, our client makes a decision at an early stage as to whether they would like us to be their financial advisor or not. But they don't have to make a decision about placement agent and/or underwriter until they have actual factual analysis in hand based on the solicitations that we perform on their behalf. So that was just a comment about the three roles that an investment banker may play to assist you in this process.
Now we'll talk more about the specific topic for today, which is debt financing for independent schools. In our opinion, debt financing is a powerful tool for schools to achieve strategic objectives. However, as you all know, it's not an occurrence that happens frequently. Sometimes schools borrow money every decade, sometimes a little bit more frequently, and sometimes a lot less frequently. Therefore, in our opinion, it pays to do it correctly the first time. So we're going to talk today about managing the costs and risks associated with debt financing to try to give you our sense of what it means to do it correctly the first time. So let's start by talking about how we think of the financing objective when we're engaged by an independent school that has a financing need. We've stated it here. The objective is to leverage financial resources, which we consider to be cash flow, unrestricted cash investments, and any real estate assets, and to invest. So that the objective is to leverage financial resources to invest in strategic and mission-driven objectives while limiting ongoing risk.
Let's talk a moment about what we have termed here the 3 C's of debt financing. The first is the true cost, that is the interest rate and the annual debt service of borrowing money. And in going through that analysis, it is not simply a presentation of what the actual cost of your interest rate and annual debt service would be, but it's also an analysis of what the cost of other options that you might be considering may be. For example, many entities are attempting to make a decision about financing a capital facility that costs, I'm going to pick a number here, $20 million. And they have various sources from which they may draw to address that total capital cost. One is that they may have, if they're fortunate, what we'll loosely call an endowment or unrestricted net assets that can be applied to the total cost of the project that they're considering. Another is that they may, and usually are, trying to match the financing of that facilities with the implementation of a capital campaign that will assist them in the financing of the total cost of the project. Part of what you should use, in our opinion, use your investment banker for, is to run analyses for you that will show you the true cost, for example, of drawing down on your endowment and spending that toward the capital project as opposed to borrowing for the capital project. In addition, you should be well aware of and be made well aware of early on of the terms, conditions, and limitations associated with the use of capital campaign proceeds in connection with the tax-exempt financing of a new project. And your investment banker should be able to assist you in that process and also to run cash flows and show you the impact of feathering in debt or structuring the repayment of debt to account for the realities of your capital campaign. The second C that we would draw your attention to would be the question of the collateral that will be necessary to be posted or pledged in order for you to finance the facility that you're contemplating. One of the benefits, going back to our dual track process of a public sale of obligations, is that covenant packages are usually quite simple. They either include a mortgage on a facility or not. And usually the school's capital facilities are in fact one of their major classes of positive assets on the balance sheet. Again, we've talked about potential drawdown of endowment. Often schools consider the use of endowment in a different fashion, and that is to pledge a portion of their endowment to collateralize a loan. We'll talk more about that later on in this presentation. That's a very significant point, something that you really need to understand before you make a decision about doing that. Further C for your consideration would be covenants that you agree to that will remain in place for the life of your borrowing. And these will apply whether you do a tax-exempt or a taxable financing, and they will apply whether you do a public sale or a private placement. We'll talk more specifically about those covenants as we go on in our presentation. Let's compare the cost and the ongoing risk of the tax-exempt bank direct placement, a taxable loan, and a fixed-rate public sale bond issue. And let's go in reverse order here and start at the bottom with the fixed-rate bond issue. A fixed-rate bond issue generally enables you to establish and set interest rates which are locked at the time of sale for a period of time up to, and in some cases beyond, 30 years. In exchange for that, you usually agree that you will forfeit the right to optionally call that debt for 10 years. So the buyer gets 10 years worth of certainty that they will be receiving fixed tax-exempt income for a 10-year period of time. And in exchange, they have locked in a rate for 30 years. In doing so, the buyer of the bonds also agrees to assume a good deal of risk. And we want to spend just a moment walking through that with you. One is that the buyer in that instance agrees that if prevailing interest rates go down after they buy their bonds, or they go up, the difference in price of the bond has nothing to do with the borrower. It is everything to do with the holder of the bonds. So movement in interest rate risk is moved from you to the buyer of the bonds for a full 30-year period. In this example, there is no reset risk associated with the bond issue. Again, you've locked it in for a full 30-year period. If after the bonds are sold on your behalf, your credit quality diminishes and the rating agency moves to downgrade your bond issue, well, that is certainly not a pleasant development, and it's something that would concern you greatly. It does not have a negative impact with regard to the bonds that are outstanding. So long as you are in compliance with covenants, and so long as you have not actually defaulted on the bonds, the interest rate on the bonds and the terms and conditions cannot change, and they cannot be accelerated. So that's another risk that is transferred to the bondholder. Another risk is that after the bonds are sold, if the federal government moves to alter the income tax or the federal tax code so that income tax rates change, and we have seen this occur very recently, a year ago in December, when there was a dramatic reduction in the corporate interest rate and a more modest reduction in the individual interest tax rate. If that happens, generally the value of the tax-exempt income that the holder of the bond is receiving is less than it was at the time that he purchased the bonds. However, in a fixed-rate long-term sale, that is not your risk. That is their risk. What I'm trying to put forward to you is that this is the most conservative way to approach long-term fixed-rate borrowing, and as such, the risks associated with that structure are the least of the three options available to you. However, the interest rate that you're going to pay, in part because you're borrowing for a long-term fixed-rate period, is higher than the interest rate that you would be paying, for example, on the bank direct purchase option. And we'll provide you more specifics on that in a moment. Actually, let's do that right now. So on a tax-exempt bank direct purchase, and again, the difference here is that your bonds are not being sold to the public, they're being sold to one purchaser. And you'll enter into a very detailed agreement with a commercial bank to buy all of the bonds issued on your behalf. In this structure, the banks, while they will entertain an amortization schedule, which is long-term, again, 30 years, they very rarely will lock in an interest rate or an interest rate index for a full 30-year period. When this new market was emerging, the initial rate set period was as short as 3 to 5 years. It then evolved to 10 years. And what Dan and I are seeing conventionally today, very frequently, is a marketplace where banks are willing to lock a fixed rate or set a fixed rate for a 15-year period, or to offer you a variable rate, which is based on a stated index, which could also apply for a 15-year period. Again, however, some of the risks that you would be willing to live with in this structure are pretty clear and very compellingly different than those in the fixed rate bond sale to the public. One is that there obviously would be a renewal risk. That is, you're not locking in for a full 30-year period. Another is that there is tax risk, and that is that if it's hard to contemplate that there'll be further reductions as dramatic as occurred a year ago, December, to the corporate income tax rate. But for those schools that entered the marketplace prior to the change in that tax code, and then banks saw their marginal tax rate cut by 14%. Usually those bond documents contained a enabling section which gave the banks the option to come back and adjust their rate or to require an upfront payment or something similar. And the argument was that, once again, that the value of the tax-exempt income which we were receiving when we had to pay 35% corporate tax rate is far less now that we have to pay a 21% tax rate, and we would like a make-whole provision exercised to reflect that. In addition, when you get involved with the purchase of your obligations by one institution, you're accepting counterparty risk. That is, you're accepting the risk of the creditworthiness and the long-term staying power of the bank that is buying your bonds. And if you are willing to consider, and if you enter into something that we don't do much of, but we do know that a lot of banks propose, and that is variable rate swap to fixed transactions. If you're willing to do that, then again, you have the counterparty risk associated with your swap counterparty. The notion here is that for independent schools, being able to borrow money on a 30-year horizon with an initial fixed rate of 15 years will enable them to significantly lower their interest rate. But they do so by willingly accepting some ongoing risk, which can in part be mitigated by the fact that usually in the bank direct purchase structure, the banks are much more flexible about allowing you to prepay your obligations. So unlike the public sale, where you agree that you won't call your bonds in for 10 years, usually banks will agree that certainly from internally generated funds, which they define as operating surpluses and/or capital campaign proceeds, you can prepay your bonds at any time with no prepayment penalty. Usually, after 5 years, you can prepay your bonds using the proceeds of a refinancing or a refunding, if you wish as well. All of these terms and conditions are to be negotiated. That's part of the value we think in having an experienced investment banker work on your behalf. Another option available to entities that are seeking to finance long-term capital facility projects is to approach banks and to request taxable loans. There are often many good reasons why you might consider that. And again, as part of our dual track process, we routinely ask the responding banks to propose both tax-exempt and taxable interest rates. Obviously, the interest rates are higher, and they'd be the highest of any of the three options that we're presenting here, because the interest is subject to taxation. It is not tax-exempt. The risk profile is essentially identical to the risk profile that you'd be speaking of in a tax-exempt direct purchase, where there is, again, a bank very, very rarely is comfortable lending and locking in a rate for a full 30-year period. Now, I know I've gone rapidly over a lot of information there. Maybe we can come back at the end and pick up questions if you have them.
So the next concept that we want to talk about with regard to managing cost is what we've called affordability or debt capacity analysis. And this is essentially borrowing the right amount. And that means not borrowing more than what the school can support from ongoing operations, and just determining as a capital project is planned what is the right amount of debt. So debt capacity analysis is a key component of new capital project planning, we think. It helps schools to determine what, if anything, needs to be fundraised, what, if anything, needs to be spent from existing resources. And it's really important in terms of articulating a plan of finance to lenders and rating agencies. So to the extent we can articulate that a school has capacity for a certain amount of debt and back that up with analysis, it certainly helps when the school is approaching lenders or rating agencies to seek proposals for that debt. The information required for debt capacity analysis is actually pretty simple. It's the last 3 audited financial statements. And the initial capacity analysis that we conduct is based on 2 primary metrics, and we use fairly conservative thresholds for those metrics. One is a measure of income statement strength and the ability to generate cash flow that would be available to pay debt service, and that we call the debt service coverage ratio. I'm sure many of you are familiar with that. We stress test 3 years of historical cash flow at a coverage ratio of 1.5. Now, it's important to note that most financial covenants do not require schools to meet that high of a threshold. It's usually 1.2. But because most schools have finance committees that want to be somewhat conservative, and nobody really wants to size their debt issue so it's right up against the covenant threshold, we set the threshold a little bit higher in this initial analysis. And the same concept applies for unrestricted cash and investments to debt, which we have set at 0.75 times, or to put it another way, unrestricted cash and investments must be 75% or more of the debt. And again, we think that's higher than the typical covenant standard, but again, we're trying to model this in a fairly conservative fashion. So on this next slide, we show the actual numbers for a theoretical school. Certainly not a PAISBOA school. But what we've done here is, as discussed, looked at 3 years, 2018, 17, 16. And for debt service coverage, assumed, again, somewhat conservatively, a 4% interest rate with a 30-year amortization and a 1.5 times debt service coverage requirement. Based on the revenues available for debt service in each of the last 3 years, we've come up with debt capacity in each of the years, and then in the bold box to the right, come up with an average. So that $37 million is the debt capacity from the income statement for this hypothetical school. But we don't stop there. We then look at the balance sheet. And here we look at cash and investments to debt. If a school has limited or no restricted endowment, then there's no real need to adjust that cash and investments total for restricted cash and investments. If a school has a large percentage of their balance sheet in restricted endowment, we would make an adjustment there to come up with a total unrestricted cash and investments number. Again, we've applied these 0.75 times goal to the balance sheet numbers. And again, in the bold box, come up with a debt capacity from the balance sheet. Now, rather than average the two of them, we think, once again, we've taken a conservative approach, and we take the lesser of the two averages so that neither factor or neither metric is violated, and come up with a total debt capacity number, which in this case is driven by the balance sheet in the lower figure of 23.7 million. We adjust for any existing debt, and come up with a new debt capacity number. So that is one way that we help schools, and that we think that all schools should manage their ongoing costs, is to start their capital planning with an analysis of debt capacity.
Just a word on that last section of our presentation. That service, the debt capacity analysis, is something that we offer to prospective clients on a free basis. And oftentimes, and the reason we do that is because it is oftentimes the pillar that folks like you are resting upon in order to advance your consideration of a capital facility need and the ability to finance it. Our next slide talks about managing cost and the value of competition in the process. Again, in our dual track process, we run a bank RFP process. And what that means, to repeat, is that we work with you to produce a comprehensive credit solicitation package. The objective of that is that the not-for-profit lenders that we know at the 35 institutions or thereabouts that we will distribute this to should receive a package which will enable them, with very few exceptions, with very few additional questions, to make the kind of credit determination that they need to make to get to the stage to issue a term sheet. And during that period, I think somewhat significantly, you as operators of complex entities are sort of shielded from direct negotiation and contact with individual banks, so that a third party is basically doing that process on your behalf. The chart that we've shown you here is meant to summarize an actual response that we did receive on behalf of one of our clients to a bank solicitation process. Let's focus on the 15-year bank commitment term. Again, everyone was asked for a 30-year amortization, and they were free to propose what they were comfortable with in terms of the initial bank commitment term. And as you can see, of the 7 responses that did provide a 15-year commitment, there is 119 basis point differential in the respondents. And we find that this is not something which is a one-time event. It is very representative of what we do see out there. And it should, I think, suggest to those who have a great relationship with one bank that even though their bank may want to continue to do that business, and you may want to continue to do business with that bank, there's no guarantee that that bank is going to be able to provide you with the best proposal in terms of what their interest rate might be. I would also say that it's difficult to chart this, but this kind of feature also, or characteristic, also applies to covenant negotiations.
So now we're going to turn to managing risk, and Joe talked a good deal about the difference between bond issues and bank direct purchases or term loans. So I'm going to go a little bit faster on this, but I do want to make a few points that are at the bottom, which is the primary ongoing risks. And we've talked about these, but I think here we've illustrated it a little bit more. With a fixed rate bond issue, the risks that the borrower retains are almost solely related to ongoing performance. That is, if you default on a covenant, or if you don't make payments, those are real risks. So you have to do that. And the remedies for not doing that include acceleration of the debt, involvement of third-party consultants, or foreclosure. In the bank structures we've talked about, there are many more ongoing risks, and we've listed them here. I think we've touched on all of them. So some of them are the same as the bond issue, the covenant risk and the payment risk. But we've listed 4 or 5 others that exist with a bank placement that do not exist in the bond market. Now, one big difference between these two structures is that for efficient market access in the bond market, what we're calling the fixed rate bond market or the municipal bond market, a credit rating is required for good pricing and attractive results from the bond issue. And as an aside, the credit ratings for independent schools, the number of schools that are rated has steadily declined over the last 10 years for the reasons that we talked about. The bank direct purchase models become more prominent. Moody's doesn't publish their independent school report annually anymore. They publish it less frequently because there's just not that many schools being rated. But we've talked today, I think, about a lot of reasons why schools might want to access the municipal or the fixed rate bond market. And just as 10 years ago, the pendulum swung in a big way towards the bank direct purchase market, our thought is that perhaps that pendulum will swing back more towards the middle over time because of some of these advantages that we've talked about with 30-year fixed rate financing and fewer ongoing risks. So it is our thought that a lot of schools are good prospects for investment grade credit ratings. And so as you think about capital planning, I would suggest that you not rule that out. That is something that schools maybe have ruled out in the last 10 years, but after the tax bill and the change in the corporate tax rate, it's something that we think our clients might want to take more of a look at than they might have in the past. And we certainly would be happy to advise our clients or prospective clients about their financial profile and their prospects for a credit rating. So that is something that we see as a potential change in the next few years, maybe more schools returning to that rated bond market.
Let's speak for a moment about managing risk and focusing on collateral pledges associated with borrowing. Independent schools have four broad categories of collateral that theoretically can be leveraged to achieve a plan of finance. Yet there are some very important considerations that should be thoroughly understood before decisions are made about pledging any specific collateral. Revenues is probably the most common collateral requirement, and indeed a general obligation of your entity is to be expected, and it is general obligation debt, which is a general pledge of revenues. It relies solely on the unrestricted revenues of your organization, and that is what you pledge to repay your debt. Most independent schools have a significant asset value in real estate. And historically, it's been very common for entities to mortgage fixed assets, specific buildings, or in some cases, a whole campus. Real estate assets, however, when they're specifically pledged, do require some interesting management in terms of consideration of future debt that may come up and so forth. And so our general advice would be to try to proceed with a financing that, if it is possible, would avoid pledging specific real estate parcels or certainly your entire campus as a source of repayment. But clearly, the better your financial condition and the greater your endowment, the higher the probability of you being able to do that will be. But it is very common in the public bond marketplace that those bonds are sold without a pledge of real estate assets. It is less common in the bank direct purchase market, but it also is a feature there as well, depending on your overall credit quality. Endowments are wonderful things to have, and many times, as I said before, the first instinct with regard to financing a capital project is either to spend down part of the endowment or to pledge in the endowment as collateral for repayment. We take a fairly dim view of both approaches, and within reason and within boundary. And what we mean by that is that, again, the analysis that an investment banker is going to perform for you should, in our opinion, show you that the returns that you can make on your endowment, or that you've enjoyed historically on your endowment funds or unrestricted net assets, should be significantly better than the interest rate that you would pay on a new borrowing. In addition, you must be very clear that if you're going to utilize tax-exempt bonds to finance a project, and you are talked into or persuaded to pledge endowment to secure that borrowing, unfortunately, you would have to yield restrict your return on your unrestricted net assets to the interest rate that you're paying on a bond. And that's clearly something that we would avoid at all costs. It's a very complicated procedure, and it's very restrictive. We've also, in the past, run into discussions frequently about guarantees. Guarantees can take a couple forms in our experience. One is from some form of a foundation or other independent 501c3 entity. And we have, in fact, worked in several instances to structure those kinds of guarantees, and they are extremely effective in improving the credit quality of the borrowing that we've been considering. Another form of guarantee that people frequently speak about is personal guarantees from board members or friends of the entity. Ultimately, we find that that's very uncommon, and as a matter of fact, I don't think in all the financings that we've done that we've ever really gotten to a point where those kinds of guarantees have been utilized. And so it's something that while we frequently get asked about it, we usually go through a discussion period that very quickly convinces people or leads them to conclude that those forms of guarantee probably will not prevail in the overall structure of the finance.
So again, we're on a slide here about managing risk and financial covenants. We've commented on these at some length. So I am going to advance past this, and if people want to come back to covenants in questions, we certainly can. We'd like to conclude today by just leaving you with a few thoughts. Again, as we started, the financing is, financing for independent schools are done infrequently, and again, we think it pays to think it through and do it right the first time. We are, as we mentioned, happy to do a few things for schools if they're considering projects, or just if they think that this analysis would be helpful to them. One is debt capacity and financial profile analysis. And for that, if anyone on the webinar today would like that service, again, we offer that for free. We would need 3 audits, and we need a week to 10 days, and we would do that for you and share the results and let you use that as you wish for finance committee discussions or capital planning or whatever else it's useful for. The other thing that we find is frequently useful to schools that are considering financing, and again, just making sure that they approach it fully informed, is to do a covenant and collateral review of existing loan documents to see if existing documents allow for additional debt to be meshed easily with the existing debt, or whether refinancing might offer opportunities to improve the covenant and collateral package. So that's another service that we would offer, and suggest that if anybody at PAISBOA is thinking about these topics, that we would do these types of reviews for you as a pro bono service initially. And lastly, I would point out that we will be at the PAISBOA annual meeting on May 8th. We'll have a table, so hopefully everyone that's listened in today will stop by and say hello in person. We'd love to see you. And Ron and Aggie, we'd be happy to take questions. I know we've used about 45 minutes so far, but if there are questions or discussion topics, we'd be happy to address them.
Well, thank you so much for doing such a thorough presentation. As I'm listening, I'm trying to think of questions, and every time I thought of a question, you answered it post haste. So we really appreciate, the fact that, you really know what you're doing. You've got a lot of experience, and, it's really refreshing to have, folks like you who are able to help our schools navigate through this really complex issue. And as you say, it's one of those things that, you don't do this every week or every day or every year. And, it is very complicated and complex. So we're lucky to have folks like you to kind of walk us through the process.
Well, thank you, Aggie. We appreciate it. We're happy to do it. And if people have questions now, that's great. If anybody on the line has questions but would prefer to talk offline, Ron and Aggie have our contact information, and it's also on the first page of our presentation.
Yep, and you'll be with us at the annual meeting, and that's also a time for people to be able to chat with you again.
Great.
Okay, so again, we want to thank everyone for tuning in, and we'll see you real soon. So again, thanks for joining us today for Debt Financing for Independent Schools.